Today, the FDIC voted to issue a proposal that would put additional limits on bank mergers with more than $100 billion in assets. Joining us now is someone who voted in favor of that proposal. Rohit Chopra is a member of the FDIC's board of directors. He's the director of the Consumer Financial Protection Bureau. Joins us now. Director Chopra, it's great to have you back on the show.
Good to see you, Morgan.
Why did you vote in favor of this? And in terms of next steps, how could this potentially change the regulatory landscape for the biggest banks?
Well, we have seen how some of these very large mergers over the past few decades haven't always turned out to be beneficial for our entire economy. In many ways, the U.S. has been lurching to a banking system that's more like we see in Europe and in China. So what we have done is vote on a clear policy that spells out how regulators are going to review these mergers. I really think this is going to make merger review faster, more predictable, but also stop anti-competitive transactions.
And certainly this has been an area of focus even just in recent weeks with the New York Community Bank Corp, which had acquired Flagstar Bank and then had acquired some of those Signature Bank assets, in the process becoming one of those banks with more than $100 billion in assets. And of course, we know has now been facing issues in recent weeks and had to receive an investor capital injection, et cetera. I'm wondering how much that factored into some of these proposed changes. And just as importantly, as we know, regulations can sometimes come with unintended consequences. How do you ensure that the largest banks now don't become that much stronger with these proposed regulations?
The key here is to make sure that the whole system is dynamic, it's competitive, and there's no question that some of the largest bank mergers have been really bumpy and have created chaos for consumers and the markets they serve. So we want to make sure, even in the merger process, that things are smooth, that it's not going to create risks to financial stability. But Morgan, you've raised another point. We also have to make sure that we look at the harms from some of these mergers of the past and make sure that those biggest banks don't continue to exploit their too big to fail subsidy. So we're working hard across the board that we can preserve a dynamic banking system.
Rohit, good to have you. I want to shift gears and ask about mobile payments, specifically tap to pay. Back in September, the CFPB put out a release. I want to quote from it. You say, as of the second quarter of 2023, Apple's iOS operating system was on 55% of smartphones shipped in the U.S., and Google's Android operating system was on 45% of smartphones. And then later you say the dominant market share of these two operating systems, coupled with the increasing shift toward mobile device payments, underscores the important role that their policies and practices play in retail payments. Are iOS and Android roughly equally influential, as you quote that 45% there?
Well, when you look at where developers and where the banking and fintech world, they often really look hard at iOS and how they will develop apps and be able to get to market. The CFPB shares a lot of the concerns with regulators around the world and banks about how Apple has imposed regulations that really stop banks and fintechs from getting to market on payments. I know that there has been obviously today's lawsuit against Apple, which talks about tap to pay and Apple's policies, how it can lead to junk fees on small banks and credit unions. So we'll be watching that very closely about ultimately how will app developers, fintechs, banks be able to serve people through smartphones and other devices.
It just caught my eye that 55 and 45 are pretty close together, and you said dominant market share of these two operating systems, but the DOJ is calling iOS a smartphone monopoly. Those two things don't seem to jibe with each other.
Well, I think when you look at the law, monopolists, sometimes there can be a number of super big players. Many people look at big payment networks and others. But here's the deal. We want to make sure that smartphones, just because they control all of the operating system, it doesn't let them dictate everything when it comes to developers of apps and other services. We have seen the problems that can occur from all sectors of the economy when big tech firms are foreclosing competition. So we'll be watching this Justice Department lawsuit pretty carefully in the banking world.
Speaking of potential suits, the credit card late fee caps that are set to take effect May 14th. Industry moved to sue to block the implementation of those. A judge rejected that in the last 24 hours or so. What happens next? And expectations around what this does to the credit card ecosystem when we know that it's a key part of those business models, for better or worse.
Well, credit card companies have been exploiting a loophole that was in the law, and we have worked to close that to save the entire system about $10 billion. I'm not surprised that the junk fee lobby is pushing back to hold on to those billions. They have been fighting in court. We have seen some favorable opinions. But Morgan, we're just going to keep on pushing to defend it so that consumers can see the results. At the end of the day, credit card companies have lots of ways to deter late payments, jacking up your interest rate, hurting your credit score, increasing your minimum payment. Adding insult to injury by exploiting this loophole doesn't really do anyone any good, except for those dominant card issuers.